Right, so let's have a look here. On the 1st of January, J Honest Accountant charges a customer $115 fees for completing his accounts. So they now owe us $115, so that's an increase in assets, accounts receivable of $115, and that's recorded in the general journal like that. We put 115 in the debit column, and in the particulars column we put the name of the account. Of course we date it. And the contra accounts, or the opposite accounts, are fees received, which is a revenue account. It has increased by $115, but $15 GST has to be paid for government. So we can't count it all as revenue because some of it actually just doesn't belong to us. It belongs to the government. Here's a description: charged a customer for accounting work. Now that description is nice, simple and sufficient to explain the transaction, but it also tells us who the accounts receivable is and how much a customer owes us. When we transfer to the ledgers and we'll look at the accounts receivable first, you'll note there that here's a 3-column ledger, and I put the accounts receivable in red just for the purpose of this presentation to show you that that's an account name. It's a heading. Now we simply go to the January 1st line where it says accounts receivable. It tells us to debit 115, so we put 115 in the debit column and describe the other accounts that relate to that. So the contra accounts, which is fees received in GST, and that leaves us with an account balance of 115. That means, accounts receivable people owe J Honest $115 and they have to pay him sometime. So let's have a look at the fees received account. That's a revenue account, and revenue accounts increases in revenue are credit, and then in this case the revenue is increasing $100. So we simply put all that information in the line. And where did that revenue come from? Well, it came from accounts receivable. So you'll see there credit 100 and a balance credit $100. And GST here, which is a liability account. It's a liability to the government. We owe the government, and it's $15 credit. It's an increase in liabilities, and it's come from accounts receivable on January 1st. So those are the 3 accounts involved in how they look. On the 2nd of January, a customer paid $60 of their account. That means they paid us $60 off. They didn't pay all of the money they owed us, they paid part of the money. And on the secondary, well, we don't need to know that yet. We just need to record the fact that $60 has gone into the bank, and $60 has been credited or come off accounts receivable. And so let's see how that looks in the bank. Oh, and of course the narration, customer paid account. Now that's that narration could probably be improved by saying who the customer was. Well, in fact it does. It says a customer paid account. So here we go, and this is the general ledger, and you'll note that we put the bank account there. It's a debit, so we debit that account, and we put January 2nd, and we say where it came from. It came from accounts receivable, and it leaves a $60 debit balance. Debit, of course, from the point of view of the accountant, means that we've actually received that money, and that we're in that we've got cash in our account. So let's have a look at the accounts receivable now. And you'll recall accounts receivable, we had fees received and GST already. So our customers owe us $115. That's what that means. It's a debit account. And now a customer has paid $60 off, and it says to credit it. Now all the crediting means is, these are just pluses and minuses. So $60 off 115 leaves with a $55 balance. Where did why has it gone down? So we look at accounts receivable, and then you can read from that that $60 has come from the bank on the 2nd of January.